Futures are mixed this morning. We've got some green for the NASDAQ 100 futures, but the Dow and S&P futures are to the downside. This coming off a green week for all three major market gauges. The Dow and S&P 500 hitting all-time highs on Friday after that strong jobs report. The economy added, of course, 943,000 jobs in July. The unemployment rate moving down to 5.4%. Joining me now, Lebenthal Global Advisors President Dominick Tavella, and joining the conversation all morning long, former Wisconsin Congressman, Fox News contributor Sean Duffy, and Republican strategist and lead partner at the Madison firm, Jonathan Madison. Gentlemen, terrific to see you this Monday morning. Dom, looking ahead, what is most weighing on your mind about the markets and what will drive stocks higher or lower? What do you see?
Well, you know, we've had a particularly good year so far, Dagan, and we've watched top-line growth. Earnings are averaging over 19% above what estimates were. So we've had a pretty fantastic year. But going forward now, we're going through a soft time in the markets. And I think, you know, the inflation data coming out this week is going to have some pretty decent effect on what we see going forward.
What will be the reaction to the inflation data? Is your concern about what the Fed might do in response to that inflation data?
Absolutely, Dagan. So up until now, it's been hot, right? Nobody can argue that point. We've seen commodity prices. We've seen things like copper and lumber really have extraordinary years. They've started to roll over. Those kinds of expensive stuff have started to roll down. But you look at also like airline tickets and you look at used car prices, they have not. And so inflation has been running really hot. Obviously, the Fed expects that stuff to roll over and be transitory. But labor has averaged over 4% growth. Labor cost has averaged over 4%. And that tends to be a lot stickier and will be a lot longer lasting. So I think the markets are focusing the combination that labor markets have been really strong and inflation might be hotter than they even anticipated. I think the Fed's going to be in a position later this year where they have to make a decision and stop their bond buying program or slow it down at least.
But they really are in a pickle, if you will. Certainly Jay Powell, the chair of the Federal Reserve, where you have now this bipartisan group of senators is signing off to spend more than $1.2 trillion. The CBO, the Congressional Budget Office, came out last week and said it will add $256 billion to the federal deficit over 10 years. Jay Powell's job is up for renewal potentially in February of next year. And you've had the Fed so far, they've monetized these debt. The debt is being monetized by the Federal Reserve. And so how can they possibly even think about pulling back on the bond buying when these yuckos in government can't stop spending money?
Yeah, in a pickle, exactly right. In a perfect world, Fed Chair Powell would like to let inflation run a little hotter than normal, get the economy more ahead of steam than it currently has. But the reality is that at the end of the day, the markets will decide where interest rates go. And if the markets interpret that inflation is really going to stick around for a really long time, and we watched this in the early 80s, the bond vigilantes come in and simply go, I am not going to buy those bonds knowing that inflation is going to eat up all my earnings. And interest rates are going to go higher and higher and higher. And the Fed's not going to have a choice. So they're going to have to play this game. I think there's going to be a lot of pressure on the Fed to at least indicate to the investment community that they're going to start thinking. And eventually they're going to slow down the bond buying program. And I think that happens before the end of this year.
What about at the Jackson Hole conference? When is that? It's coming up later this month, isn't it, Dom?
Yeah, coming up the end of this month, but we have a really important data coming out on CPI and PPI data Wednesday and Thursday of this week. Again, everybody expects it to be hotter than normal. The question is, will it linger around much longer than what the Fed is telling us, or will it roll over? We watched the price of lumber come way down again, but when you give somebody a 4%, 5% raise so they can come back to work, so they can come back to the office, you cannot wake up 6 months later and go, oh, it's all good now, and we're going to take that raise away. That kind of labor cost sticks around for a really long time, and I think that in the end will give the really the excuse to the Fed to go, you know what, we have to do something here.
Yeah, any regular person understands that higher prices are here to stay. When somebody raises prices, like even if it's a raise, the lower prices never materialize. Just really quickly, how are you allocating your portfolio for the second half of the year? Any changes that you've made?
Yeah, look, the U.S. markets, domestic markets have just been fantastic, right? Less so on the international side. And I just spent the last 30 days, I visited Europe, I visited the Middle East, and I visited Africa. And I can tell you all three continents are really struggling to try to deal with COVID and get their businesses back in line. They are way behind us. I think you have to start nibbling in these areas. I think you have to start allocating, get there early. You can't wait till after those markets react to go, oh, that's a great space. So this is where you start rebalancing some of your U.S. equities and get into the international sectors.
Right. You have, knowing people who've been traveling overseas, you have no idea what great shape the United States is in, broadly speaking,
honestly,
until
you are 100% correct. If you look at what's going on, especially in the labor force, restaurants opening, shops being able to function, we are so far ahead of the rest of the world, at least what I saw. We are so far ahead of the rest of the world. It really is troubling, but they're catching up. So 3, 6, 12 months down the road, they'll be where we are today. You got to go where the hockey puck is going to be, not where it is today. And internationally, you start very deliberately moving pieces of your, maybe 2.5%, 5%, but you start moving that part of your portfolio from domestic to international and capture the returns 3 and 6 months down the road.
Dom, great to see you. Dominick Tavella. We'll see you soon.